Markets started 2021 on the same bullish note as they ended 2020. Progress on vaccination rollouts, low interest rates, and a monetary system awash with liquidity, and fiscal stimulus from governments worldwide. All these factors were in place to support economic recovery. But then investors got skittish about inflation and pushed up longer-dated bond yields, bringing about a bout of volatility. This tug-of-war between the bulls and bears will continue to play out in the market, making this a good time to take stock of one's portfolio and look for investments that can withstand the turbulence.
Where have returns been greatest and where have returns been less strong? When something has been over-earning relative to its long-term history, it probably is a wise time to kind of take a pause and think if the better returns going forward will be available from elsewhere.
Experts say growth stocks, particularly those in the tech space, are one example of an overvalued sector.
We've seen that overperformance of the growth style versus value now running for over a decade. Some of that will moderate. And even if that doesn't necessarily mean that markets have to have a big correction in prospect, it means that the shape of returns could broaden out. So you would get an internal rotation in the market.
Other experts, however, continue to see opportunities within selective growth stocks.
Some of these circular themes, like for example, in digital consumption, cloud computing, cybersecurity, I think these themes are going to be intact, even if we go into a post-pandemic era, right? So with the recent market pullback, and we see share prices of a lot of these related stocks actually coming back down, it is a good opportunity to actually cherry pick and pick out some of the good quality names that have actually consistently delivered growth.
Market watchers say investors can look to value stocks. These tend to be cyclicals, which means their performance is linked to the strength of the economy.
This could include stocks in the financial or energy or commodity space. But bearing in mind, some of these stocks have also run up. So you do want to look at names where the risk reward is still attractive, and also companies, businesses that are actually running well in terms of operations versus their peers.
But as with tech stocks, investors will have to be selective.
Quite a number of these cyclical sectors are still facing structural headwinds. For example, within the energy sector, right, there's this drive towards more green, renewable energy, right? So for oil and gas company, is it trying to actually adjust its mix away from more fossil fuels into those renewable energy? I think that's one important note to think about. And then within the financial sector, right, we also see the emergence of fintech going into the financial space. So how are your traditional banks actually facing these competition and actually trying to evolve their business?
ESG, or environmental, social, and corporate governance investing, is also set to gain more prominence in investment portfolios. And research has shown that it pays off.
There are empirical studies, not by one manager, but by many asset managers, who are able to show that companies of similar country or similar sector have significantly outperformed if they have been incorporating sustainability objective in their company mission, and more importantly, supported by the successful implementation of those goals.
Related to the sustainability theme, brown or non-green sectors like oil and gas could see growing investment interest.
We are actually seeing a number of these, especially oil majors, trying to turn more green, right? Trying to change their energy mix. It's going to be a process. So, but if the valuation actually, is attractive, and I think if you do see these companies making good efforts and good progress in becoming more sustainable, I think it is actually worth considering investing in some of these companies.
ESG may be hot, but investors need to be careful not to overpay for these stocks.
We did see some speculative trading frenzy at the beginning of this year, including some of these sustainable related sectors, right? For example, the electric vehicles, right? A lot of them are actually still very good businesses, but because the valuation may have actually run ahead of the fundamentals, we did see some profit taking. So I think for investors looking to invest in these sustainable related sectors or businesses, I think you still need to be mindful of valuation.
There is one investment theme that has lost some favor among investors, though. REITs, or real estate investment trusts, have historically been popular because they offered a steady stream of income.
We need to be careful about those that are likely to suffer as a result of falling occupancy rates and lower rental yield. But by and large, some of the other companies are well prepared for this. So they're working together with the tenant, come up with solutions to tide through this period. We really need to do a lot of homework to understand each individual REITs company and whether they will benefit or they will actually suffer as a result of the COVID situation.
Building a resilient investment portfolio requires regular check-ins to make sure the portfolio remains relevant to one's investment profile and needs.
While you need to review, but we would not suggest investors to overtrade. And I think the critical thing here is to adopt a longer-term view on investments, because I think that would be a better way to ensure and enhance your overall risk reward.